High interest rates and high inflation continue to weigh heavily on the Korean public. To help alleviate the burden, the Yoon administration has called on major commercial banks and communication giants linked closely to everyday expenses to share the financial burden with the people. And the order is now headed towards a major overhaul of the country's banking industry to break the oligopoly system large banks have enjoyed for decades. Let's talk a little bit more about this with Professor Yang Jun-sok, who joins us on the line. Good morning, Professor Yang.
Good morning.
It seems that banks in particular are being pressured to redistribute their wealth. It seems necessary for us to first explain market share. Korea's top 5 commercial banks, that's Kookmin, Shinhan, Uri, Hana, and Nongyup. They apparently dominate over 70% of the country's total deposits. Can you first tell us more about the top 5 banks' market share and how did it all begin and how overwhelming is their dominance?
Okay, well, by most measures, Korea's banking system is moderately to heavily concentrated, depending on which measure you use. Korea has fewer banks than most other advanced countries. According to an organization, Hegi Library, in 2019, Korea had 54 banks, but compare that to United States, which has more than 4,500, UK, which has more than 300, Germany and France, which each had 259. So Korea falls way behind those countries in the number of banks. The only major country that Korea seems to be ahead of is Japan, which only has 27 banks. So there are fewer banks, and more likely that they will have monopoly powers, restricted competition. And if you look at the concentration ratio, which looks at the total market share of the largest companies in the industry, sometimes it's CR3, 3 companies, or sometimes CR4, 4 companies, or CR5. Korea's CR3, that's the share of the 3 largest banks, is 61.9% for household loans and 62% for all loans. And now, it is below 75%, which is considered heavily monopolistic, but it's fairly high. If you compare it with other countries, then CR5 for Germany, US, and UK are below 40. China, France, and Japan, the CR5 was about 50. Again, Korea seems to have a very high concentration ratio, which implies that there's less competition. Now, the economists like to use this figure called HHI, and this is preferred over the concentration ratio because it gives weight to the largest. It gives larger weight to larger players, so it's a better indication of whether there's a monopoly power. And if you look at the banking industry, then, well, the United States, the HHI is somewhere between 500 to 600, and compared to that, the Korea's HHI is 1697. Now, if you look at how much that number changed historically, in 1998, HHI was around 600, but it started increasing during the 1997 financial crisis and reached about 1290 in 2003. And again, it's about 1697, close to 1700 right now. Now, 1800 is considered sort of a borderline for having perhaps concentrated industry, less competition. So we're not quite at that level yet, but we're very, very close, and we're for the banking industry at least, we are higher than most other countries.
Okay, so by almost every measurable standard you just mentioned, Korea's top 5 banks, the biggest 5 banks, are awfully close to having monopolistic hues. Not quite there, but close. Professor Yang, I do wonder, because I'm not quite sure if our listeners understand the background as to then what led to just five banks dominating market share. Can you try to explain the reason the number of Korean banks are so low? Why do we have fewer banks than most other advanced economies?
Well, the simple answer is that the government made it that way. And that's basically because of one or two paths. Whenever Korea had weak banks that were in danger of going out of business, Korea would merge it with stronger banks. Mm-hmm. And that's partially because until 1997, Korea really didn't have a insurance deposit. So if banks went out of business, then people who put their money savings in that bank would basically lose all their savings, and obviously no one wants that. So government would sort of pressure the stronger banks to take over the banks in trouble, and that obviously reduced quite a number of banks. But another reason is that around late 1990s, early 2000s, there was sort of a belief that Korea needed mega banks. Mm-hmm. Korea needed very large banks to compete with investment banks overseas from the United States or European banks. And the major component of that was actually the construction industry. Korea was trying to increase the exports of construction services, large construction projects like building nuclear power plants abroad. Mm-hmm. And whenever you're trying to export these type of large construction services, the financial deals sort of come with that. So whenever, let's say you're trying to decide between which construction companies you want to use, well, each construction companies not only have expertise in construction, but they have the different types of financing that they offer to you. Mm-hmm. And what type of financing that you can offer depends on what kind of partnerships these construction companies have with large financial institutions. And it was felt at the time that because Korea's banks, the size were too small, they couldn't offer comprehensive financing deals, so Korean construction companies, it was at a disadvantage. Personally, I thought that was a wrong approach to take at the time because, well, you don't really need to have a large single bank to finance these type of deals. Other countries use what's called syndicate loans, which is sort of a loans made by partnership or group of banks rather than just single bank alone. And the advantage of that is not only that a bunch of small banks can make large loans together, but it also spreads the risk around, whereas if one bank financed this whole large project, then they would be very vulnerable to what would happen with that project. But still, the idea back at the time was that Korea needed large banks, and the way to do that is to merge these banks together. And so that's a major reason why we only have 5 major banks now. The government encouraged the banks to merge into a giant mega bank. It was hoped that not only would the mega banks grow in size, but they would also be able to innovate and offer goods that the smaller banks would not offer. That didn't turn out to be as
successful as they had hoped for, it seems, right? Professor Yang, I just want to intervene because I really want to ask you this question. There was government efforts to attract companies to establish internet banks, but to no significant avail. Market share is actually quite minuscule in the single digits for 3 of the biggest, it seems, internet banks, Kakao, Toss, and K-Bank. Why was that not successful?
Okay, well, first of all, internet banks were not designed to be very large banks. So in terms of market size, it was much smaller than the big 5 banks. And then there's lot of laws and regulations, which makes entry into the banking industry very difficult. Now, some of this is understandable because the financial industry sort of supplies money to all of the economy. We really do need to be careful about who gets to be a bank. So there's a lot of conditions on who can enter the industry, but Korean laws and regulations tend to be tougher than other countries, and that has kept companies or potential entrepreneurs from coming into the banking industry. We also saw that for Kakao Bank, for instance, they had to form a investment group to form the Kakao company, Kakao Bank, and sometimes the partners have some problems with each other. Because banks need a lot of capital, it's very rare that a single entity can provide enough funding to establish a bank on its own. So you usually have to have a sort of a partnership. And again, laws and regulations concerning these partnerships sometimes make it very hard for a partnership to form and start a bank.
Professor Yang, it seems that the government wants to intervene, maybe stop the big five from having too much market share. The government has rolled up its sleeves to break the oligopoly by inducing competition in key banking businesses. Exactly how would competition help break up the near monopoly system, and how realistic do you think is the government plan?
Okay, well, government has plans to perhaps use the UK challenge banks as a model. They also have plans to form a comprehensive repayment, computerized repayment process, and use that comprehensive process to calculate interest rates for lending institutions and make the interest rates, both borrowing rate and the saving deposit rate, public. Both of them are, I think, good ideas, but they fall a bit short. The challenge banks are smaller banks which specialize. So some may specialize in small, medium-sized enterprises. Some may specialize in consumer spending. And in UK, they have been very useful in introducing number of competitors. It's basically what Korea has been trying to do with the internet banks. But as you just mentioned, it was very difficult to get more internet banks into Korea because of existing laws and regulations, even though Korea thought that they loosened it enough to get more competitors. Turned out it wasn't. So we would need further changes in laws and regulations if we want more players in the banking industry, and that would include challenge banks for the repayment system and transparency announcements in interest rates. That is, again, a very good idea. Transparency, I think, is almost always good, but you also have to remember. You also have to keep in mind that there's potential problem there. Very recent literature in anti-monopoly policy, competition policy. Sometimes, if you announce those prices, instead of leading to competition, it leads to implicit collusion. What I mean by that is, if you post the interest rates or prices for the largest, most powerful companies, then the other companies, instead of trying to beat the price, may say, well, let's just go along with that price. We don't need to compete. We just need to follow the largest leader. So there is a possibility that such transparency in prices can lead to collusion rather than competition. So the answer is that not only do you need transparency, but you need a better implementation of antitrust, anti-monopoly competition policy, and that means more role for the Korea's Fair Trade Commission.
So it seems that there's a lot to be careful for, and some economists remain skeptical that these efforts, including that very British challenge bank model, it might fall short. Could it do enough in disrupting the oligopoly and diversifying the banking sector? So going forward, Professor Yang, what do you think is a key to the success with all these regulation changes? What are we exactly aiming for?
Okay, well, what we ideally would want is more new banks to provide competition. And we tried to do that. We talked about internet banks. And before internet banks, from the around mid-2000s to mid-2010s, there was an attempt to try to have more competition in the financial industry by breaking walls between banks, securities companies, insurance companies, and other financial companies. For your listeners who have been around long enough, they may remember something called bank assurance, which means that insurance companies or security companies or banks can sell the same product so that they can compete with each other. So even if the number of banks are small, because you have security companies and insurance companies selling similar or same products, you can lead to more competition. But that kind of fizzled out during the mid-2010s. So ideally, we would like more banks, but there seems to be something in the Korean laws and regulations which makes entry into the market very, very difficult. And then another problem is that because we have the big five banks right now taking so much of the market and being so big and strong, that even if other banks can come into the market, they're sort of afraid of the dominant players, so they may be discouraged into entering this market and competing with those mega banks. So again, if you want to have more players in the banking industry, the Fair Trade Commission may have to enforce the competition policy more strongly and try to ensure a more level playing ground even for the new players if we want to actually have more banks in the Korean financial system.
Do you think the government actually wants more competition? Is that what they want?
I'm not quite sure, frankly. And that's because Korea has this long history of controlling banks. If you go back to, say, 1970s and 80s when Korea had industrial policy, especially during the 1970s, the government basically told the banks where to lend money. So it was an independent bank in name only, and a lot of banks were actually state-owned enterprises. And during the late 1980s, these banks privatized and they became private banks. But there was a lot of accusation that government was still controlling the banks, if not directly, then indirectly. And even now, government seems to have perhaps more of an influence than what we see in other countries. For example, it's very hard to see somebody becoming a chairman of one of the big five banks unless the government approves this person. It's very hard to imagine in Korea somebody at the government who disapproves becoming a chairman of, say, one of the five largest banks. So it's easier for government to control the financial system if there's fewer banks. So that may have a role in it as well.
Okay, so that could be a potential hurdle too. Thank you very much, Dr. Yang, for today's conversation. We'll speak to you again next week.
Thank you.
If you're listening to our program using the podcast service, just a reminder that we do go live Monday through Friday, 7 a.m. Korea Standard Time. So tune in and help us make the show more informative by giving us your input. See you bright and early on Good Morning Seoul.